Entry, exit, and economics. Those are the 3 E's of any trade. And today I'm going to walk you through a couple of day trades on one of the hot stocks of the day. So I have a number of strategies that I use to day trade the stock market, but they all revolve around a simple idea, and that is I want to focus trading stocks that are abnormal. So stocks that nobody cared about yesterday that then come alive today with abnormal price movement, abnormal volume. The hot stocks of the day is where I want to focus. Now, I need to have, or all traders really, need to have an edge in the market. And my edge is that I can find these hot stocks before most people using computer algorithms. So I've got some proprietary indicators that I've written for a program called TradeStation, and it goes through every stock trading on the US stock market looking for statistically significant abnormal price and volume activity. Now, when that happens, my indicator called an action candle is triggered. So I have a process that runs on the screens you see behind me, and it's looking for any stock that makes an action candle on the 2-minute interval. And I then look at the symbols as they come up of all these stocks that are making these abnormal moves over the last 2 minutes. So again, I'm trying to catch these things before most people do. So ANY was the stock that triggered this today. And it was on the 4th bar of the day. You can see right here. And notice that there's a little pink dot there. It's a little bit hidden, but right there, there's a little pink dot. There's some other pink dots. All of those are action candles. They're all 2-minute bars that made an abnormal price gain with abnormal volume. Now you can see the volume is much stronger today than yesterday, and the price action is much more abnormal than it was yesterday. So this abnormal price action is caused by a group of investors or traders all rushing into that stock at once, typically motivated by some news, some rumors, perhaps a chat room, a very large chat room might get everyone in their chat room to buy the stock for some reason. But what happens is there's usually something behind it, and it's like a pebble being thrown into a pond. Initially, it's the people that follow the company the closest that know about that exciting bit of information, and then it slowly moves outward until everybody in the market knows about it. And the idea is I want to be close to where the pebble first hits the water, maybe on the first ripple. I don't want to be 10 ripples out, right? So I'm looking for stocks that surprise with strength, and then I do some basic analysis and some economic calculations, which we'll go through in just a moment. And from that, I can determine whether the trade is a good one. So on ANY today, it was a good trade on my day trader strategy right here because it made an action candle that surprised the market. I'm not interested in these ones because that's already well into the upward trend. So what we're looking for then is to enter this stock 8 minutes after the open at $2.40. And we do a calculation for risk management based on the height of that candle. All right, so that's the top of the candle and that's the bottom. And the difference between that is the difference between $2.40 and the low of the candle was $2.34. So that's a difference of 6 cents. Okay? So from that, I can now calculate position size. So position size, what I'll do is I'll take the risk per share, that's 6 cents, right? The 6 cents, not the 6th cents, 6 pennies, and I'll calculate my position size based on the risk I'm willing to take. So if I'm willing to risk $100 on a trade, then it would be a position of 1,660 shares. And if you look really closely at the chart there, it's hard to read, but it actually writes it in there because again, I've coded this all into the computer so it can be pretty automated. So the program in TradeStation, the indicator that I've written for TradeStation finds it. We have a service on Stockscores called Active Live where we share all these things as they're happening in real time. You can go to stockscores.com and learn more about that. So the entry price 240, the risk management price 234. That's a risk of 6 cents a share, which means the position size is 1,660 shares for every $100 of risk. If you were willing to take $1,000 of risk, well, then you take that 1,660 shares, multiply it by 10. Now you've got 16,600 shares for that position. All right, so that's the initial entry calculation. Now let's just take a quick look at the economics of this. So our entry price was 240, that's the entry. The risk management price, we call this R1, is $2.34, giving a risk of $0.06 or 0.6 cents a share. And if we divide that into 100, it equals 1,660 shares in that position. All right, now let's talk about the exit. So this stock was moving up quite quickly, and it was quite liquid, quite abnormal. So instead of watching it on the 2-minute, I'm now going to jump to the 1-minute chart to look for an exit. And because this stock essentially went straight up, our first exit signal is on a break of the upward trend. So if we look at the chart, you can see that this stock went straight up and it gave an exit signal right there, and that was at about $2.62. Okay? So then we can go back to our economics, and we bought 1,660 shares at $2.40, and the exit was at $2.62, so that was 22 cents a share in profit. 22 cents a share in profit times that gives us our profit for the trade. Very quickly, it's like $36 or $360. Now that is a multiple of risk. Let's go back to the first chart, and what you'll see is exactly that. So here is our entry point. This is what we call R1. This is 2 times risk. This is 3 times risk, and 4 and 5. You can see the numbers on there. And so if our exit price was at $2.62 right there, it was just a little bit under 4RR. So 4RR, if we are risking $100 per $100 in this trade, would be a $400 profit. If we're risking $1,000 on this trade, it would be $4,000. I always measure performance in RR. That way you have a sense of what is your average profit versus your average loss, regardless of how much you risk. So in this trade, if you're risking $1,000, it makes a $3,700 profit. In order to do that, you had to risk 1,000, so you made 3.7 times risk on the economics. So that was trade number 1, and that's trading off of the 2-minute chart. Now this stock gave another entry signal on another strategy I have called a pullback play. Pullback play is essentially looking for the buyers to recharge. All right, so you have this move up, you have a pullback. That is recharging the buyers, because you're getting all of these people, or some of them anyway, are taking profits, and it brings down the average cost that people hold the stock at. It clears out some profit takers, and then when it breaks the pullback right there, we get a new buy signal. Now this little white dot here is something called a message candle. It's similar to an action candle. It's called a message candle, and it's an abnormal price move. And what we want to see is an abnormal price move that breaks the pullback. So that was entry number 2. And we can do the economics again. So our entry price is there, our risk price is there. I just have to eyeball it because I can't get the exact numbers, but it's roughly an entry of, say, $2.57 and $2.52 on the low side. So if we go back to the economics, the entry is $2.57. The risk minus R1 is $2.52. Whoops, $2.52. That's a risk of 5 cents. So if I'm willing to risk $100, I would buy 2,000 shares. If I'm willing to risk $1,000, I would buy 20,000 shares. If I'm willing to risk $200, I would buy 4,000 shares. So you always let your position size be driven by the economics of the trade, by the risk of the trade. Now in this case, the stock rallied up to resistance, which is where we expect it to get stuck. It then broke its linear trend line right in there. So you've got a pretty good exit signal round about $2.72. So if you enter at 257, you exit at 272, that is a profit of 15 cents a share. You risked 5 cents a share, so you made a reward for risk of 3. So to be a good trader, you have to understand when to enter, when to exit, and then understand the economics of the trade. So many traders forget about how much reward potential they have for the risk they have to take. It's a foolish trade to risk $1 a share to make 20 cents a share. That makes no sense. You want your RR potential, your reward for risk potential, to be at least double and hopefully more. And a great trade is when you get above about 8 RR. So sometimes we get trades, usually 1 or 2 a day, will move more than 5, 6 RR, and every once in a while you'll get one that moves 15, 20 times risk. Those are the real golden goose trades. But most of them, small 2, 3 RR winners, and you have a few -2 RR losers. Those kind of balance each other out, and then you get the big winners that come along, the 3, 4, 5, 10 RR winners at the end of the week. That's where the profit comes from. So if you're aspiring to be a trader, remember, entry signal, that's a strategy that you have to have. Exit, that's a set of rules for knowing when to sell. And of course, that RR calculation, the economics of the trade. Those are the 3 E's. Keep them in mind when you're trading. Hope you've enjoyed this. If so, click the like button, subscribe to the channel, and trade well.